In the second lecture, we set up our charts after answering the questions below. How do we know if we are in a diverging market without indicators? How do we know we are in trending mode? How do we eliminate fake setups? How do we remove subjectivity? We answered these questions by saying we need the TDI to know if we are in a diverging market. We use the EMAs to know we are in a trending mode. And for this and this, we use the hybrid of those. In this lecture, and by the end of it, we should be able to count levels with high precision on any asset of choice, have a concrete analysis flowchart to attain market bias, anticipate points of results, and lay foundation for entries. So this is going to be a very important lecture in your learning. You should actually make sure to take some notes so that you fully comprehend each and everything that we'll talk about. Labeling calls for special steps that calls for use of logic. Trading is actually a logic business. We are not going to approach the markets rigid but with high flexibility. We will have a guideline to follow so that we will not become subjective. Here is the level counting sequence. The skill you are going to attain is applicable on all trading assets. You will carry out a top-down analysis starting from the monthly time frame down to the lower time frames. As mentioned earlier, a cycle is terminated by a multi-period MOW. This must be accompanied by divergence on the TDI, which is defined as opposite directional movement of the TDI and price chart. We are saying whenever they create an M pattern, usually on the price chart, it will look like this. But on the RSI line, it will be something like this. Divergence is a basic concept that is available for free, which we will not delve into as a topic, but will actually define it on the charts. The sequence of analysis is as follows. Firstly, we go on the monthly time frame, then to the weekly, daily, H4, H1, and then lastly M15 for entries. Why are we talking about these time frames? Because on MT4, MT5, these are the default time frames. But on TradingView, it's actually a different case. Higher time frames are meant to give bias so that we may see where the market is going, as you have seen in the previous chapters. You need to memorize this sequence. The first thing that you do is check for the 50 EMA touch, check for the break of the impulse high. By saying 50 EMA touch, we are saying we need to see a 5013 EMA cross. After that 1530 EMA cross, we need to see a 50 EMA touch. After that 50 EMA touch, we need to see break of the high of the previous impulse, like in this case. Then from there, we look for the preceding time frame data. Therefore, any 50 EMA touch is actually going to be our starting point in the preceding time frame. We will actually take a horizontal line and place it on the 50 EMA, as I'll show you on the charts. The next thing is now to verify the levels. To clarify this, it needs to be done on the charts. So let's now learn more on the charts and learn how to label them correctly. So as I've showed you on the charts, the first thing is to go on the monthly time frame. And I've told you that this method works on any tradable asset. It doesn't matter, it's an index, it's a crypto, it's a currency, any tradable asset. But you need to follow all the concepts that I've told you. The first thing is to go on the highest time frame. And this is gold against USD. On the highest time frame, what we'll be needing to see is to see whether the market is actually trending or not, and to find the datum for the lower time frames. In this case, we can see that on the monthly time frame, we have a crossover of the 13, 15. The 13 in red, 50 in blue at this particular point. When they crossed over, they gave us a touch of the 50 here. However, looking forward, there is also another touch or a consolidation at the 50 EMA that was issued at this particular point. This is what we can see on the monthly time frame. The touches of the 50 EMA are basically to simplify segmentation of our levels. We have the first impulse, break of the first impulse by the second, break of the second by the third. As we've talked earlier, we've said these are going to be our impulses which have higher highs and higher lows. Therefore, when we mark our levels, we'll need to use rectangles so that they will be easy to see and they will be easy for our analysis. Therefore, in this case, we have the first rise, then the second rise, and subsequently the third rise, which we haven't verified on the lower time frames. We've said the last bounce on the 50 and a break of structure will be actually a datum for our smaller time frames. From the monthly time frame, we are now going to the weekly time frame. On the weekly time frame, this is where we marked our level on the monthly time frame. To simplify everything, I am now going to put the period separators, which you can put on TradingView as session breakers. This is how they look like. I would be trying to actually increase or reduce the subjectivity in seeing our segmented moves. In this case, we have our 50-13 EMA cross at this particular point and our touch of the 50. We've said that is the first thing that we need to do whenever we are approaching any time frame that we have. After that, we can see that the market went to the upside and touched again the 50. After that, we broke structure twice, this one being the first break of structure, and then this one was supposed to be a break of structure which was later cleared. Therefore, break of structure occurred at this particular point. Break of structure twice leads to end of a cycle. At the end of a cycle, we expect to get a multi-period M pattern in this particular case. And with that in mind, we expect to get what we call divergence on the TDI. Divergence will actually look to see this on the price chart and the opposite on the TDI. So marking our levels using a different color, because we are now on the weekly time frame, they will now look like this. First level, then second level to the 50 EMA touch, and third level like that. So going back to the weekly time, to the monthly time frame, we can see that we have been issued 3 weekly levels in this particular case, and the market is still going to the upside. We've said whenever the market is still going to the upside, or whenever a market has not yet complete, we expect to see a reset, which is basically this one. If we go on the higher time frame, this is actually a touch of the 50 EMA like that. Therefore, on the weekly time frame, we are now dropping to the daily time frame. On the daily time frame, this is what we see. We can see that from this particular point, the market went to the upside and came back to the lows and went to the upside again like that. But on the weekly time frame, we can see that there was a rise and a retest of 50. We've said the first touch of the 50 becomes a datum of the lower time frame. Therefore, this is going to be our datum for the daily time frame. Going on the daily time frame, we can see a rise, pull back to the 50, becoming the first touch of the 50, rise, pull back to the 50, and then rise again. On the daily time frame, we can insert our rectangles so that we can mark the levels like this. First level, second level, and then the last level to the upside, which has not yet been confirmed. This becomes our datum of the next time frame, which is now the H4 time frame. Going on the H4 time frame, this is what we see. We can see a move to the upside, touch of the 50, another move to the upside, touch of the 50. This is a quality cycle. Whenever we have twice touches of the 50 as well as twice break of structure, it's actually a quality cycle. Therefore, marking our levels, they are going to look like this, where we have level 1, level 1, level 2, and then level 3, which has not yet been confirmed. This becomes our datum for a lower time frame. Going on the H1 time frame, this is what we see. We can see that the market actually went to the upside. A crossover of the 50-13 was here, then touch of the 50, and then they broke structure for the first time. So what are we now expecting? We are now expecting to see completion of this cycle. If we are to mark levels, we are going to say level 1, level 2, and we are going to expect to see level 3 for the subsequent completion of the cycle. So basically, this is how we will do it. Let's now have several examples so that you fully comprehend where we are coming from. I am going to pick a difficult index, which is UK 100, and try to mark these levels. We've said the first thing is to go on the monthly time frame. On the monthly time frame of this particular index, we can see that we do not have enough data. This broker doesn't have enough data, but what we can see is there was a touch of 50, break of structure, touch of 50, break of structure, and we reached the high of the cycle where we had a multi-period M pattern. From that, we can see there was a reset point. Right? A reset point was issued. From that reset point, we can see a 1350 touch of the 50 that was issued, meaning that this is going to be our datum for the lower time frame. Going on the weekly time frame, this is what we see. There is not much. Therefore, this is also going to hold as our datum if we go to the daily time frame. On the daily time frame, we can see that there was a crossover of the 1350 EMA to the upside, like this. This was the first level to the upside. Since there was a 1350 crossover, then there was break of structure at this particular point. From that point, we can see there was now the second level, which has not yet been completed or confirmed. Therefore, on this particular point, which is the 50 EMA interaction, is now going to be our datum for the lower time frame. Going on the lower time frame, which is the H4 time frame, we can see that we had the first level, which was a 1350 EMA cross, consolidation at 50, second level, pull back to the 50, third level. Therefore, we have 3 levels to the upside, which becomes 1, 2, and 3. 3 levels to the upside, and now we are waiting to see a pattern to short this index. Whilst we are on shorting this index, we are still expecting it to go to the upside. Why? Because on the weekly time frame, we still have two levels like this. Therefore, if we look at this particular case, we are waiting for a pattern which we will learn in chapter 4 of this course. Let's have another. Now it's going to be a cryptocurrency. The first step is to start on the monthly time frame. The monthly time frame of BTC against USD, we can see that we had touch of the 50, touch of the 50. Our last touch is going to be our data for the lower time frame. On the lower time frame, which is the weekly time frame, we can see that there was crossover of the 50, touch of the 50, and then the market went to the upside. However, this requires verification. How do we verify? We need to see the whole move on the lower time frame, which is the daily time frame. On the daily time frame, this is how it looks like. We can see that there was touch, touch, and then end of the cycle. From there, we had a reset which actually started from this particular point, and this particular point being our level 1 to the upside, and a touch on the 50, and then we rose to the upside like that. After 2 levels, we are expecting to see the 3rd level so that we can get into the 3rd level of this cycle. So with that in mind, we have the first level, the second level, and then the 3rd level like that. Therefore, if we are to continue, we are now saying this is going to be our data because it is a 50 EMA cross on the higher time frame. Going to the H4 time frame, this is what we see from our data. We can see a crossover of the 1350 EMA cross, bounce on the 50, bounce on the 50, and we went to the upside like that. Therefore, we can safely say this is level 1, break of structure, level 2, break of structure, level 3. The last bounce to the EMA is actually going to be our data for the lower time frames. If we go on the H1 time frame, this is what we will see. On the H1 time frame, from the data, we can see that the first bounce, the first rise was this one, and there was the first bounce. Always remember that the first bounce will segment the first level from all other levels. In this particular case, there was proof of manipulation that occurred on the 5th of March. However, whenever this comes, we would say the quality of a cycle is poor. Therefore, we're going to say level 1. If you check on other brokers, this was not available. This pullback to these levels were not available. Up to level 3, like that. Break of structure twice, and then we had first leg, second leg, and the market went down. On the TDI, we can see that there was a drop, whilst on the price chart, there was a rise. In this particular case, we had a reset point, and we have already started to go to the upside. This becomes the first crossover. This becomes the first touch to the 50. Therefore, we are now anticipating to see another impulse to go to the upside so that we can say this is level 1, level 2, and then level 3 going to the upside like that. All right, let's try another difficult and more consolidating cross. CAD against CHF. We've said that the first thing is always to start on the higher time frame. On the higher time frame, what do we see? The monthly time frame, we can see that there was a crossover of the 1350 EMA cross, drop. Another pull back to the 50, drop. Then pull back to the 50, and then they actually went to the downside. What what's next right now after this has occurred. When we look at this cycle, we can see that there were moments where there was consolidation. When they reached this point, we could say there was now a completed cycle. This being the first leg, this being the second leg, as evidenced by the TDI. That is why I've said the TDI is there to confirm and show us that the market is not going where we are thinking it's going. It's actually going in the opposite direction. The relative strength index will be telling us that this is, of course, this is dropping, but that is not what is happening. Therefore, we can see that this lowest point and this one, they are actually diverging. They are actually opposing each other, converging in view, but we can as well call it diverging. So from this particular point, we can say this is the lowest point available, and that is where we are going to start off our analysis. On the weekly time frame, this is how it looks like, which is basically not enough information. We go on the daily time frame. On the daily time frame, we can see that we had a rise at 1350 EMA cross, a touch of the 50 break of structure, meaning that we had level 1 and then we had level 2. We are expecting level 3, but level 2 has not yet been confirmed. This becomes our datum of the next time frame. On the H4 time frame, we need to see how everything is actually moving. On the H4 time frame, this is how it looks like. We can see that although we've seen on the daily time frame as 2 levels, that is not exactly what is being told, what we are being told on the H4 time frame. Why is that so? That is where we were saying verification of the levels. The prior level time frame can tell you otherwise, and the preceding time frame can tell you otherwise. That is why you need to verify if you are actually doing the right thing. In this particular case, we can see a 1350 EMA cross, reaction to the 50, break of structure, rise. Reaction to the 50, break of structure, rise. This means this whole move to the upside is one daily rise because it's actually compressed on the H4 time frame. Therefore, we do not have 2 levels of the daily time frame, but we have 1 level on the daily time frame. Still on that, whilst on the H4 time frame, this becomes the last retest to the 50 becomes our datum for the next time frame. From this point, going to the H1 time frame, we now need to see what is taking place. On the H1 time frame, we can see that we had a crossover of the 1350 EMA and then a rise, meaning that we had a level to the upside from this particular point to that particular point. Why did I include this phase? Because it was a rise that first broke our high, but later it came back to the low, which means it was in consolidation mode. Then we had another rise to the upside, which is this one. And then the last rise was issued. What we now expect is basically divergence with our TDI to see this market go low for a moment before resetting to continue going to the upside. I understand that this might be difficult at first, but with time, you will definitely catch it. Moreover, with our sessions that we'll be carrying out, you will actually grasp the concepts and understand this whole principle. On that note, we've come to the end of our lecture. See you on lecture 4, where we will talk about entries and patterns. It will actually simplify how you see these things, and you actually see that you do not need as much knowledge in levels to find entries on the charts.